Your employer just gave you a 15% discount on company stock. Congrats, you just won. Except the IRS is about to take a piece of that. Could cost you thousands in unnecessary taxes if you don't understand these three critical timing rules. And I'm willing to bet your HR department didn't explain any of this. Here's what happens every single day. Say Sarah buys company stock through her ESPP at a 15% discount. Feels like it's free money, right? 6 months later, she needs to cash for a down payment, sells the shares, and thinks she only owes capital gains tax on the profit. Tax season arrives, her accountant drops the bomb. She owes ordinary income tax on the entire discount plus capital gains. So her $12,000 profit just became $4,800 tax bill instead of the $1,800 she budgeted for. This exact scenario happens hundreds or thousands of employees every single year, and it's completely avoidable. So I'm an EA and CFP who spent 15 years untangling equity compensation disasters, and I've seen every ESPP mistake imaginable. The IRS has an entire publication just on employee stock purchase plans, publication 525. Your employer's 2-page summary didn't cover this. So today we're breaking down the complete tax treatment of ESPPs, the stuff that can save you thousands per year in unnecessary taxes. No jargon, no confusion, just the exact rules you need to know. First, let's establish what is an employee stock purchase plan, because the tax treatment depends entirely on the plan structure. Most ESPPs are Section 423 plans. That's the IRS section that governs them. And here's how that typically works. 1, you contribute up to 15% of your salary through payroll deductions. This is after-tax money, which is crucial for later. 2, your employer offers a purchase discount, usually 10 to 15% of the stock price. That's the maximum the IRS allows under Section 423. 3, here's where it gets interesting. Many plans have what's called a look-back provision that lets you buy at a discount from either the start of the offering period or the purchase date, whichever is lower. So let me show you why this matters. Let's say your company stock is $100 when the offering period starts. 6 months later, it's $130 with a 15% discount. In look-back provision, you're buying $130 stock for $85 because it's taking the 15% off the 100, which is the lower amount. Now, here's what most people miss. That $85 purchase price represents two different types of value. $15 is your official discount from the $100 offering date price, but there's also a $45 gain from the stock appreciating from 100 to 130 during that offering period. So the IRS treats these very differently depending on when you sell. And this is where people lose thousands. So now you might be thinking, why does the government care when I sell my stock? I already paid for it. Great question. The answer is because Congress wrote these rules in 1964 and apparently decided that anything involving employee benefits should be exactly as complicated as possible. And, frankly, I'm convinced there's a secret government office somewhere people sit around asking, how can we make this require 3 different tax forms, 2 pages of supplemental documentation? It's like they looked at the tax code and thought, you know what this needs? More exceptions to exceptions. But understanding their Byzantine rules is worth thousands of dollars, so let's break them down. So everything in ESPP taxation comes down to those two categories, qualifying dispositions and disqualifying dispositions. These are judgments by your character. They're IRS terms that determine your entire tax treatment. So qualifying disposition means you held the stock for at least 2 years from the offering date and at least 1 year from the purchase date. Both conditions must be met. This is an and situation, not an or situation. So miss either deadline by even 1 day, and you've got a disqualifying disposition. So a disqualifying disposition is everything else. Selling before you meet both holding periods, gifting the shares, transferring them, even dying while holding them if you haven't met the timeline. Yes, the IRS literally considers death a disqualifying event. Because apparently they want you to tax you even in the afterlife. Now here's where the magic happens. The qualifying disposition and why it's worth the wait. Let's use an example. Stock was $100 at the offering date. You bought at $85 at the purchase date when it was worth $130. You holding it for the qualifying period, you sell at the $100 and you sell it at $150. Here's your tax treatment. Only the official 15% discount, the $15 per share, is treated as ordinary income. That's it. Just the discount percentage applied to the offering date price. Everything else, all $65 of additional gain, is taxed as long-term capital gains. This includes both the $45 appreciation during the offering period and the $20 gain after purchase. So you're paying a maximum 20% federal plus on that $65 gain instead of the 37% ordinary income tax rates. On 100 shares, that's a tax savings of over $1,000 compared to ordinary income treatment. This is the key benefit of qualifying disposition. You convert almost all your profit into capital gains rates. Only that official discount gets hit with ordinary income tax. Now, here's where most people get destroyed: the disqualifying disposition. This is the part most people miss. When you sell early, remember, early means before 2 years from the offering and 1 year from the purchase. Here's what happens. The entire discount, that $45 between $85 purchase price and the $130 fair market value at purchase, gets treated as compensation income and added to your W-2. So let's break this down carefully because this is critical. In our example, you bought at $85 when the fair market was $130. That $45 difference, gets reported as ordinary income under W-2, not just the 15% official discount, the entire difference between what you paid and what the stock was worth at the purchase. Then any additional gain beyond that fair market value at purchase gets taxed as capital gains. Short term, if you held less than a year from the purchase. Long term, if you held for more than a year, but less than 2 years from offering. So if you sell at $150 after 6 months, you have $45 of ordinary income in your W-2 income, plus $20 of short-term capital gains, both taxed at ordinary income rates. So potentially 32 to 37% federal. Your employer withholds taxes on this compensation, but usually not enough. Most people don't realize the entire discount, not just the 15%, will be added to their W-2. So compare that to a qualifying disposition. Qualifying, you had $15 of ordinary income and $65 of long-term gain. Disqualifying disposition, you have $45 of ordinary income and $20 either short-term capital gains or long-term. And if you're in the 32% tax bracket, that difference costs you about $4,800 in extra taxes on just 100 shares, multiplying that across multiple purchase periods, and you see why this matters so much. So now remember that look-back provision I mentioned. This is where things get even more important to understand. When your plan has look-back provision, that appreciation during the offering period, the gain from the offering date price to the purchase date price, that's what shifts from capital gains in a qualifying disposition to an ordinary income in a disqualifying disposition. So real example, your company's stock is $100 at offering date. 6 months later, purchase is jumped to $130 with a 15% discount. You buy at $85. So again, if you hold qualifying and sell at $150, you have $15 of ordinary income and $65 of long-term capital gains. If you sell immediately at $130 disqualifying disposition, you have $45 of ordinary income and zero capital gain. If you just converted $45 of what could have been capital gains in ordinary income by selling too early. So at a 32% tax rate, you just paid $1,440 in taxes instead of $900. You lost $500 in unnecessary taxes. This is why I never recommend immediate sell in ESPP shares when their stock has appreciated significantly from the offering date to purchase date. You're voluntarily converting capital gain into ordinary income. At this point, you might be wondering, why did I agree to this plan? Well, because even with the tax complexity, it's still beneficial. It just requires understanding these rules to maximize your after-tax return. So let's talk about how to actually optimize this. All right, so here's a strategic framework for minimizing taxes on ESPP shares. 4 decision rules that cover 95% of situations. Strategy 1, immediate sale for diversification when appreciation is minimal. If the stock hasn't appreciated much from offering to purchase, the tax cost of a disqualifying disposition is lower. So if you need to avoid concentration risk because the company's stock already represents more than 10% of your net worth, Selling immediately can make sense. Yes, you'll pay ordinary income tax on the full discount between the purchase price and the fair market value at purchase. But if it's only the $15 to $20 per share, you're still getting an instant return after taxes. This is especially smart if your company's stock is volatile or your industry is facing headwinds. It's more of an investment decision instead of a tax decision. Strategy 2, hold the qualifying treatment when the stock has appreciated significantly. This is a big one. If your stock appreciated substantially from offering date to purchase date, you absolutely want to consider holding it for a qualifying period. That appreciation during the offering period, that $45 in our example, shifts from ordinary income in a disqualifying disposition to capital gains in a qualifying disposition. Run the math. 100 shares with $45 of offering period appreciation, qualifying treatment saves you about $2,700 in federal taxes if you're in the 32% tax bracket. So that's real money. But critical caveat, this only works if the stock doesn't decline significantly while you're waiting. So you're risking real money to save tax dollars. So a major decline can wipe out the tax savings. My rule, only hold qualifying tax treatment if tax savings are substantial, and typically when the stock appreciated significantly during the offering period, and you'd be comfortable holding that stock in your portfolio anyways. And that's critical. Don't let the tax tail wag the investment dog. Strategy 3, same-day sale programs when look-back gains are small. So many companies now offer same-day sale options where shares are automatically sold at purchase and you just pocket the discount. If your stock doesn't have much appreciation from offering or from purchase or offering to purchase, meaning the look-back didn't create a large embedded gain, the same-day sale makes sense. You get the discount with zero market risk and zero concentration risk. Yes, it's a disqualifying disposition, but if the tax cost is minimal because there's little offering period appreciation, you've eliminated all downside risk. Strategy 4, strategic loss harvesting. If you're holding ESPP shares and they've declined, you can strategically sell at a loss to offset other capital gains, then immediately repurchase through your next ESPP period. The wash sale rule doesn't apply when you're buying through ESPP because that's considered a compensatory transaction, not a market purchase. You can deduct the capital loss while maintaining your ESPP participation. So let's talk about the paperwork nightmare, because this is where most tax mistakes actually happen. So your employer reports ESPP transactions on Form 3922. You'll actually get this by January 31st following the year of the purchase. This form shows your offering date, purchase price, and fair market value at both dates. Keep every single one of these forms. When you sell, your broker reports the sale on Form 1099B. But here's the problem. They don't know your cost basis because they don't know how much discount compensation your employer already reported. This causes double taxation if you're not careful. Most common mistake, your employer reports $2,000 of ESPP discount as compensation on a W-2 for a disqualifying disposition. Your broker reports the full sale proceeds on 1099B with a cost basis of just your purchase price. So if you don't adjust your cost basis on Schedule D, you pay tax on that $2,000 twice, once as a W-2 compensation and once as capital gains. So the fix for disqualifying disposition, your actual cost basis is the purchase price plus the amount you already reported as compensation or W-2. You need to make this adjustment manually on Form 8949. This single mistake can cost people thousands in overpaid taxes. The IRS doesn't automatically flag it because you're overpaying, not underpaying. 3 insider moves most people never consider. Advanced move 1, state tax arbitrage. If you have ESPP, shares move from a high tax state like California to a no tax state like Texas or Florida, wait until after you move to sell your qualifying disposition shares. California can't tax capital gains for non-residents. The benefit is even larger if you have substantial appreciation during the offering period, since that converts to capital gains in a qualifying disposition. Advanced move 2, charitable contributions. If you're charitably inclined to have appreciated ESPP shares, past the qualifying period, donate the shares directly to a charity instead of selling. You get a deduction for the full fair market value, never pay tax on the appreciation. You still owe ordinary income tax on the 15% discount portion, but you avoid capital gains tax on all the appreciation. Advanced move 3, year-end tax planning. If you're close to qualifying holding period at the end of the year, consider whether it makes sense to wait a few more weeks to push the sale into next tax year while also achieving qualifying status. This is especially powerful if you're having a high income year and would benefit from deferring that income. Here's what you need to do right now. Action 1, pull out your last ESP pre-purchase confirmation, look at the offering date and price and purchase date price, calculate the appreciation during the offering period. If it's substantial, set a calendar reminder for 2 weeks before you hit the qualifying period to evaluate whether to hold or sell. Action 2, review your last tax return. Look at Form 3992 information and verify that your Schedule D shows the correct adjusted basis. Remember, for disqualifying dispositions, your basis includes the amount reported on your W-2. If not, you may need to file an amended return. Action step 3, calculate your current company stock concentration. If it's above 10% of your net worth, evaluate whether tax savings from a qualifying treatment outweigh the concentration risk. If you found this valuable, the subscribe button is right there. I break down equity compensation, tax strategy, and wealth building every week with the same level of detail. In the meantime, stop overpaying on your ESPP taxes. The IRS isn't going to tell you whether you're doing it wrong. So make sure you go check on these things. Until next time, cheers.